What is up? What is up, Bobby? How you doing, man?
And doing great, doing great. Another great day.
Let me see that ring again.
Yes.
Recruiter.
Army recruiter.
What's up, everybody? Welcome to Hard Earned Knowledge, episode 11.
Yes, I think it's 11.
Episode 11. We are on episode 11, Hard Earned Knowledge. Why do we call the podcast Hard Earned Knowledge? Because we did it hard so you don't have to.
Indeed.
That's pretty much what it is. You know, we're going to actually be developing a website called hardearnedknowledge.com. It's not up yet. We're also going to be developing curriculum for this particular podcast so that you can rewatch it or digest it on YouTube or whatever. But we have things to talk about related to the car business and business in general.
Indeed.
And we're glad that you're joining us today to check it out. So my name is Ronnie Haskins. We are Auto Search USA, as you can see in the corner. We're auto broker in Colorado Springs, Colorado, providing vehicles of all types to all different types of clients. This is Bobby Jones. He is part of the team. 20-year military man, was a legendary recruiter in the Army, and now he is an auto broker with our team. So welcome, welcome, welcome.
Good to be here.
So, you know, the news has been going on with the interest rates. Like every day, something else is going on. What's the latest things that you've heard?
I'm hearing it from both sides. You know, the mortgage people are saying the rates are up. You know, it's tough time to buy. Some of the real estate agents are saying they can do some special things with the market and find ways to get people in homes and things like that. So, I mean, it's just a challenging concept. It's a challenging conversation right now for everything that I've heard.
It feels like it happened overnight too.
Yeah.
You know, like it just like all of a sudden it was just there.
Yes. Yes.
Like we saw it coming. Like, you know, I think that part of it, you don't like listening to it, like negative energy, like, oh, y'all been saying the rate's gonna go up forever.
Right.
That how many times do we have the news say the Fed's gonna announce the rates and it stayed at zero?
Yes.
Remember that? Bernanke and Yellen, you know, all of those guys were like, it's just stayed at zero forever, but now it's real.
Yep.
And I have this document here that states, like, this is from today. On Wednesday, September 28, 2022, the current average rate for the benchmark 30-year fixed mortgage is 6.86%. That has gone up 54 basis points in the last 7 days. So today's average 30-year fixed refinance rate is 6.9. That's gone up 54 points. The 6.86 has gone up 48 basis points since the same time last week. The refinance rate, which they're trying to slow that as well, is at 6.9. 54 basis points in the last 7 days. So these mortgages were 4%.
Yeah. I'm just under 3%, you know, at 2.85. I did that back in 2018, you know, so it was a hot time.
Recent enough, but the market was different.
Yeah.
Pre-pandemic.
Yes.
You know, this is going to affect a lot of people, you know, and so we're in the car business, and we're going to talk a little bit about interest rates and how they're going to affect your car loan. But, you know, mortgages and car loans are they sound the same, but they're not.
Yeah.
In a certain way, right?
The math is much different.
The math is different. Like, you know, compounding interest is just different. Actually, you know, that's a funny thing, the terminology, right?
Right.
Car loans are simple interest.
Simple. Mm-hmm.
Yeah. Compounding interest on mortgages. I'm not a scholar on mortgages, but I believe they're compounded.
Mm-hmm. It's simple. It's just a much bigger number, I think. You know, it works the same way. You know, it's tied into the same concept, the same math, but yeah.
So, you know, basic fundamentals that I think I know, and anybody can correct me at any time. When you finance a car or a house, for the first few years, you're paying mostly interest.
Yeah.
And then it starts to slowly catch up and you start paying down the principal as time goes on. You know, mortgages are 30 years. Car loans are 5 years, 60 months, or 72 months for 6-year loans. Some folks go 84 months. Same type of scenario.
Right.
Not as painful in cars because it's just not enough time for that interest to compound to hundreds of thousands of dollars.
Exactly. And basically what's happening is over time, as that principal reduces and that payment is staying the same, now you start that balance of more money going towards interest and less money going towards principal starts to balance out over time and over payments, to where by the time you got 5 years left on your home, you know, you're paying mostly principal instead of interest, because the interest is getting paid up front, people, you know. So if you're buying a house and you got a 30-year mortgage, chances are it's paid off in 15. Now you paid off the interest and now you're paying the principal. for yourself.
So this is why they say, like you were talking about it a little bit earlier, we don't have the clear specifics on it. You have to check with your own mortgage lender to get the data on it. But if you make it, my mom always told me, if you make an extra payment a year, it shaves off like 7 years.
Yes.
Don't take that to the bank. Check with your mortgage person, but because it's speeding up the interest pay down. Is that why?
Exactly. You just put you put a lump sum towards that principal payment, so instead of having 10, 20, whatever the percentage is going towards interest and trying to balance out, you only got a small amount going towards your principal. You got 100% of your current payment going towards your principal, which knocks that down. And now your interest payments and, the balance of it goes further.
Interesting.
Yeah.
Sorry to use the word interest so much.
I know.
Yeah.
No
so
pun intended.
Yeah, no pun intended. So interest rates in the car loan, guys, like it's not as painful as people think.
Right.
I have some data to share. Let's take, I'm not going to share the screen because it's got some client data on it, but let's take a $43,000 car in 2020. The interest rate was 4.09% for 75 months with $1,000 down. Including taxes, they were financing $46,845. So that payment was $716 for 75 months.
Right.
Now, if you change that rate to what the current rates are, and they're going to vary by lender, but 5.19 for 75 months, payment was $716. Now it goes to $741. That's $26.
Doesn't seem like much, right?
It doesn't seem like much, but
right.
The total interest you're going to pay now over the life of that loan is $8,800 versus $6,800.
Right.
So like, it doesn't seem like much. Yep. I can handle the payment, but what is the real effect of it? Well, the real effect is you're going to spend $2,000 more on that one car if you make all the payments.
Right.
Lots of people pay the cars off early. You can avoid some of that interest, but this is just the truth of the matter.
And these rates that we're, the examples, these are people with really good credit.
Oh yeah. This example is on A+ credit.
Yeah.
So best rates you can get right now in the marketplace. So like it's not as good as it used to be. We had a point less not too long ago.
Yeah.
So cars are going to cost you more money long term if you're financing them for 5 years or more. That's just a fact of the matter.
Yeah.
Now, how you can avoid this, some of this interest on these deals, because cars aren't as bad as mortgages, right?
Right.
1 point on a mortgage is going to change your payment a lot of money. I would need a mortgage person to tell me how much on like a $400,000 home or $500,000 home here in Colorado Springs. But, I would imagine it's going to be a few $100s,
right.
So, or more.
Right.
So,
I mean, we pay for a home, you pay for them twice. I mean, if it's a $400,000 home with all that interest and everything tied in, you're almost paying $800,000.
Yeah, you pay for them twice. So like if you if you buy this $43,000 car and it's 5%,
right,
you're going to end up spending $55,000. Now that's including taxes,
everything. Yeah,
$3,600 in taxes. So like that's $55,000. It's not buying it twice.
Yeah, that's not bad at all.
$86,000 would be twice, but yeah, when you buy a house, it's literally twice. I don't even want to look at how much I paid on my house.
I know.
In the past 20 years. You're telling me it's going to be twice. Yeah.
You knocked out most of that interest. The house is paid for at this point. At 20 years, the amount of money that you've put towards it, house has been paid for. Now, and the bank take that. That's gone. Now you're knocking down principal. Now you're getting your house.
Does the bank ever do anything but take? I bet they're also hoping I stop making the payments.
Exactly. So they can take it back.
So they can take it. People fall in love with their banks, and I'm always like, well, they love you as long as you're giving them money.
Exactly.
Or putting money in deposits. Then they
exactly.
Hey, Mr. Haskins, how are you?
Yeah.
But like,
their money is insured.
Yeah.
Their money is insured by that collateral. They're going to get their money one way or the other.
How does a higher interest rate affect your payment? I forgot to put that banner up there. So like, if you're looking at, let's use a much softer example. Like right now, I think, in Colorado Springs, average car is like $30,000. If you're looking at like, let's say a random SUV, RAV4, Forester, something like that, 5-year payment at 4.74%, $621 a month.
Mm-hmm.
Last year it was like 3.5, 602. So it's about $20.
Right.
Right. Make sure I'm not crazy here. 4.74. Yeah. About $20 a month is what it's gone up, which equates to a couple of thousand in interest over the life of the loan.
The life of the loan, full 5 years.
So I guess what I wanted to tell people, how do they affect your payment? It's like, it's affecting it.
Yeah.
It's not as drastic as a home or buying a building or buying a long-term property or something like that, because it just doesn't have enough time to compound into that much of a drastic payment increase. But it is definitely costing you more to buy a car right now with these interest rates.
Right. Absolutely.
So
to be expected.
Yeah, to be expected. I mean, it's such a shock because people are seeing it in the news.
Yeah.
Interest rates are so high. They've gone up. They're going up again. It's like, it doesn't mean you can't buy a car. It just means they're going to cost you a little bit more money.
And I mean, we've gone 12, 13 years of great interest rates, like since 2009, back when all of that stuff happened.
I would say 2001.
Even further back. Yeah, exactly.
Everything was in the threes.
Yeah.
I don't know if you guys realize that. Like, I've been doing this since 98 and the rates never really changed that much.
Yeah, for cars, absolutely.
Actually, they went down. Like after 9/11, we had the catastrophe, we had all of that, and then we had 2008. The rates kind of went down because they were trying to spark the economy.
Mm-hmm.
But it's just on fire now. It's like they're dumping gas on it. So they're trying to slow it down by raising the rates.
Yeah,
and it's affecting the housing industry quickly and cars. So, all right. So, what else would you like to drop in the knowledge category about higher rates and affecting payments and stuff like that? What have you researched?
I mean, for the most part, obviously not doing any exact numbers or making any promises, but when it comes to cars versus houses, because there's a smaller amount of interest that you're paying, an extra payment or two earlier in the loan, 3 to 5 years later after you bought the car, it won't do that much damage, but you knock off some of that interest, a straight interest payment earlier in the loan, you could really reduce that $2,000. That's going to reduce drastically, and maybe that, somewhere along the line, it'll be less, half. I don't want to give numbers, but, so thinking about doing an extra payment would definitely reduce the impact of the higher rate.
Yeah.
Just a little bit is,
What else can you do to impact it?
You can work on your credit. I mean, you always want to work on your credit. So if you notice that this is happening, so pay attention to your credit, pay attention to your scores, pull a credit report. You get them for free. On some of these websites. I don't want to broadcast any particular website.
You could just go to YouTube.
Yeah.
And learn about credit. So let's talk about credit and how it affects you. People with the best credit pay the least amount for money.
Absolutely.
People with the best credit pay the least amount for money. Mm-hmm. That means the majority of us are paying for all of the money.
Mm-hmm.
And so if you can look at it reflecting the credit scores, right? So if you got a pen and paper and you're taking notes, if you have a 740 plus credit score in most scenarios, if you're buying a house or you're buying a car, that's going to put you in what they call A plus category.
Mm-hmm.
So there's no way to get the rate lower by having a higher score than that. We do have people that have 800s and higher, but there's no lower rate. So once you go over 740, which should be a goal, you qualify for the best rate, which is the lowest interest on the money. Right now it's 4.99%, which, some people are like, that's high. I'm like, well, it is because the market's high.
Right.
But if you have, let's say a 660 to 689, now the rate's 6.24,
mm-hmm.
And so now let's go back and put that into the calculator. So if you go on that $30,000 car at 4.99 for 60 months, the payment is calculating $625. No money down, financing all the taxes and everything at 499, and then put in 6.24. Let's look at that. So that's, oh, by the way, that's $4,300 in interest, $625 a month for 5 years. Now we put in 6.24, same car, same money. Instead of $4,300 in interest, it's $5,500 in interest.
Right.
Payment $644.
Right.
So it may not seem like a lot, right?
Yeah.
But over time, like, these decisions are affecting you, and what people forget about is the power of that money.
Right.
So if you didn't have that, what else could you do with that $20?
Yeah.
Like if you had that $20 a month and you were investing it and earning 6%.
Absolutely.
Over 20 years, now it gets a lot clearer because it's like, whoa, this is the reason why you want to get your score as high as possible.
Exactly. And that's within our control. It's very few things that we can control when we talk about interest, but we can control our credit score. Just like you said, you can go to YouTube and you can learn more about it, and you can find different ways of manipulating your score by making payments on time or
Yeah.
doing this or doing that. So it's well within our control. It's probably one of the few things that's in our control.
Yeah, I mean, that's the thing. Looking at your credit score is going to impact you, and it's sneaky. It's like, oh, I can afford the payment. Like I can afford the payment, so it's not a problem. It's like, okay, but you're not able to invest even $100 a month.
Right.
That you're actually paying more for the car could be going somewhere else. So you have to start writing those things down, looking at them, and how they're affecting you, not over 5 years, but over like 10 years.
Absolutely.
Then it becomes $20,000.
Exactly.
You know what I mean?
Because you look at what that $100 would have done over the course of that time, and you're sick to your stomach.
That's what I'm saying. Like you can go look at that stuff on YouTube.
Yes.
You can educate yourself. I'm not a guru on it, but I do know the power of being able to invest consistently, and so that's something that I hope people are understanding.
Absolutely.
These rates aren't really drastically changing their lives, but they're sneaky.
Yeah. Yep. They got you for another $1,200.
So what else can you do to work on your credit score? All right. So cash down, during pre-pandemic, 2018, 2017, 19, everything was zero down. Everything was this, that, or the other. This goes back to what I preach a lot. Planning. That's the most boring word you could ever hear.
Yep.
But planning your auto purchases, it's like, we know the rates are higher. First of all, do you have to have a car today? Maybe not. Maybe we can put it off 6 months. You can come up with $3,000 in savings to put down on that car. On a $30,000 car, that's 10%. That's going to help you.
Right.
So if we look at that, actually, people don't know this. If you put cash down, you can get a lower rate.
Absolutely.
You can get like a 1/4 point off if you have enough cash down.
Yeah.
Because the bank doesn't have to take as much of a risk on you.
And it's funny that you should say that, because a lot of times the client or the person buying the car may not know, but I mean, your broker or whoever it is that you're dealing with should be telling you this. Like, hey, there's levels. It's a technical term for it. I can't think of what it's called, but there's levels to it. When you go over a certain number, you're in a different interest rate category.
Yeah, loan to value. So they look at the loan to value. It's called LTV.
Yeah.
Once you have enough cash down, 20% would be preferred. So that's $6,000 on a $30,000 car. So if you got $6,000, the payment goes from, let's say your score is 680, right? So you got $644 a month. You put $6,000 down. Now they're going to lower your rate a 1/4 point. So let's see what the payment is. 5.99, right?
Mm-hmm.
524. So it's $120 a month. Whew. And it's only $4,300 in interest instead of, dang it, I should have wrote that down.
That's a jump. I know I forgot it too.
6.24. No, I'm going to forget this one. All right. 4,300 in interest.
524 to
55. So
yeah,
$1,200 more in interest.
Mm-hmm.
You can shave that off, right? You put the cash down. So this goes back to planning. If your car's getting older and you want to do something, try to put it off, save some cash, be ready to put some cash down, get yourself a better rate, get yourself a lower payment, and less obligation over the next 5 years. So that way you have a chance to get that car paid off.
Right. And you're paying interest. You're basically just paying interest on a smaller number of money, direct principal payment.
Yeah.
Before you bought your car.
Yeah, it helps a lot.
It helps a lot.
And that's the thing that nobody was talking about in 2019, 2018, when everything was being, subsidized, like factory incentives and rebates, and everything was 0%.
Right.
Those loans are great. Like 0% loan. I'm not saying anything's bad with that. Like, there's just no interest. There's actually no reason to pay that off early.
Right.
Put it on auto pay.
Invest the rest.
Yeah, I mean, it's like this thing is.
That's it.
I mean, there's something to be said about, like, you got that much cash, okay, pay your car off. But 0% is just not going to hurt you. I can't find an argument against 0%.
Yeah.
But if you did a long-term loan in 2018 with a 2.9 or whatever, and you finance the taxes and everything, put anything in it, right now you may be in decent shape, but we don't know. Right. The market is still really volatile. But today, if you're buying a car, and especially in the used market, make sure you're putting some cash down.
Yes,
if you can. So let's see what else I had. What else can you do? Mm-hmm. So as usual, guys, if you have any questions, please drop them in the comments. We would love to answer you when we can. And subscribe to the YouTube channel. We're going to be coming on here every week doing videos on this type of topics. If you need information on stuff you'd like to know about, let us know. We'd like to get those topics researched and bring you the information along with our educated opinions. That's what it's all about. It's a podcast. It's not the gospel. It's just what I think after doing this for 20 years.
Yeah.
You know, I've developed quite an opinion on all of these cars things over a long period of time. So not always right, but the things I do talk about usually work out for me.
Yeah, it works.
So anything else you want to add?
No, planning, budgeting, getting ahead of it.
Yeah.
You know, because it's a shocker to some people, you know, when they walk in the door and they hear those numbers, it's like, you should have an idea. Even before you walk into a dealership or walk into a broker's office, you should have an idea.
I really love that. I mean, you can just Google it. Like, you can talk to your phone.
Yeah.
What's that payment on 30 grand car plus taxes today?
Right.
It'll probably spit it right out for you.
Right.
You know, average credit, good credit, bad credit, whatever, you know, lower end credit, you know, it's like, it's going to change.
You should know your credit scores. I mean, most credit cards companies now have it where they can tell you your FICO score at a minimum.
Yeah.
You know, so I mean, just having an idea of what that number is super important.
Well, you know, that's a good point, Bobby. Like, you should know your credit score, or the dealer should be able, if you're not working with us or anybody, that we should be able to explain why you're getting the credit score you're getting, you know, why you are qualified for this rate.
Right.
Like, there's a form you sign with us that says your interest rate was dictated by your score, not based on how we feel or what we want to make on the deal. It's you qualified for this because you are a 740. And here's what this particular credit union offers for this particular credit score.
Yeah.
And we can shop them. There's several credit unions we use in town. We have 30 in total, but like there's 3 that I work with a lot, and their rates are usually very similar.
Right.
People tend to like to work with the credit unions that they're already a member of. So, but that's a great point.
Great.
Figure out what your credit score is. Don't use credit. Don't use the free sites. I would use a pay site.
Right.
That way you'll get something real, or actually go to one of the 3 credit bureaus: Equifax, TransUnion, or Experian. Yeah. And you have to pay for that. Like, I think these free ones aren't really worth their weight. I haven't seen them work out well for people as far as being accurate. So I would definitely look into purchasing a score. So,
yep.
All right. Anything else you got?
I think that covers it.
All right, man. Well, we'll be back next week. Subscribe to the channel. Let us know if you'd like us to talk about anything. And we appreciate you joining us. Have a great day, guys.